美国突然打下关税核弹，中国卖家的利润直接腰斩。
The US suddenly dropped a tariff bomb, slashing the profits of Chinese sellers by half. There's no way to pivot to Southeast Asia, and now the cross-border industry is in chaos. Major logistics companies halted operations overnight, and videos of overstocked warehouses in Shenzhen have gone viral. A seller told me that now even sending out a package requires recalculating the cost 3 times. But is there really no way out of this situation?
毁灭性的打击这次真的来了。
I can tell you directly that we haven't secured a single order. This has been a devastating blow. Just this morning, we received the unfortunate news that the US has increased tariffs on Chinese businesses by 79%.
On April 2nd, the US government reignited global debate by imposing a 34% reciprocal tariff on China, adding to the 20% increase from March and bringing the total tariff rate to 54%. Under President Trump's sweeping tariff policy, China's foreign trade sector is facing significant disruption, and cross-border businesses are under considerable strain. According to Chinese customs data, exports from China to the U.S. in 2024 exceeded $520 billion, accounting for 14.7% of China's total exports. The main export categories include electrical machinery, steel products, and labor-intensive goods such as toys, furniture, and clothing. If the U.S. were to completely shut its market to China, no other country or group of countries could fully replace it. From this perspective, the continued tariff increases by the U.S., now totaling 79%, are likely to have a direct impact on China's foreign trade and could also slow its overall economic growth. Some experts argue that even with China's advantages in low production costs and labor conditions, it is nearly impossible for exporters to turn a profit under tariffs approaching 100%. The more they export to the U.S., the more they lose. This signals the end of the export windfall China enjoyed during the pandemic. As a result, all 3 of China's main economic drivers, exports, investment, and consumption, are weakening, and the country's GDP is expected to decline by approximately 1% to 2.4% this year. According to the Financial Research Institute on Zhongtai Securities, net exports contributed 30% to China's economic growth in 2024, boosting GDP by 1.5 percentage points. This year, that contribution is expected to turn negative. In fact, the impact of Trump's tariff policies has already begun to show. Data shows that in the first 2 months of 2025, China's imports shrank significantly and exports slowed considerably, especially in traditional export categories such as clothing and accessories, furniture, footwear, and toys, with a notable year-on-year decline ranging from 6.9% to 18% across the various products. As the U.S. imposes high tariffs on Chinese goods, the global economy, already under trade pressure, faces a new challenge. No single country or group of countries is capable of absorbing the $500 billion worth of Chinese goods previously destined for the U.S. Moreover, no government is likely to risk its own industries and employment to accommodate low-cost Chinese products. Reuters reports that Beijing has advised export-oriented companies to explore alternative markets or pivot to domestic demand. However, this shift is also difficult given current overcapacity and sluggish internal demand.
美国加征了关税以后
With the new U.S. tariffs, how can we sell our products? Could Africa become a key market for relocating our excess capacity? Let me share something with you. Many people are seriously underestimating the strength of Chinese manufacturing. What does that mean? In Southeast Asia, places like Thailand, Vietnam, and Malaysia, and even farther out in Indonesia and the Philippines, the competition is already intense. Some of our capacity can be shifted there, and yes, countries like Mexico, Russia, and those in Africa might be able to take some of our goods. But even if they all bought everything we had, it still wouldn't be enough. Do you see what I mean? The surplus is just too large. Relocating capacity doesn't mean wiping it out completely. It only helps reduce a portion. Our inventory is massive. You might not realize it, but there's simply too much production. Take textiles, for example. A single town, Dalang and Dongguan, can produce enough in 1 month to clothe the entire world for a year. And Dalang does this every single month. Isn't that staggering? For many products, the demand is fixed, but our output far exceeds that. This isn't something that can be resolved in 10 or 20 years. Even if the entire world tried to help us absorb the excess, it still wouldn't be enough. As this owner said, the scale of Chinese manufacturing is staggering. Most of the major markets people can think of are close to saturation. The global market has a demand ceiling, and overcapacity could lead to inventory piling up, resource waste, and intensified industry competition. Chinese social media has seen videos expressing sentiments such as, cross-border e-commerce sellers' world has collapsed.
美区跨境的天塌了。
The US cross-border e-commerce market has collapsed, truly collapsed. Many businesses in China may not yet sense the warning signs, but a wave of cross-border sellers will soon be forced to shift to domestic e-commerce platforms. However, the domestic market is already saturated, with severe overcapacity and intense competition. These returning sellers are sitting on mountains of inventory in their warehouses, and they're in urgent need of cash. They will almost certainly slash prices across domestic platforms, triggering even more intense price wars. I strongly recommend that everyone act quickly, start building operations across multiple platforms, and stores as soon as possible to prepare for the brutal competition ahead. The US's continued tariff increases have significantly raised the cost of Chinese goods in the American market, sharply reducing their price competitiveness. Additionally, with Trump's trade plan extending tariffs to other countries, China's options for avoiding high tariffs through transshipment have been further restricted. During Trump's first term, many Chinese export-oriented businesses relocated production lines to countries such as Cambodia and Vietnam. Vietnam, in particular, has emerged as a key hub in this new wave of manufacturing shifts. However, the US has now imposed tariffs of 49% on Cambodia, 36% on Thailand, 46% on Vietnam, along with tariffs on South Korea, Japan, India, Indonesia, and others. While officially aimed at addressing trade deficits, these measures also clearly target China's supply chain. In Vietnam's case, Chinese manufacturing transfers are heavily concentrated in labor-intense sectors such as textiles, furniture, and consumer electronics assembly, together accounting for 80% of the total. In 2024, Vietnam recorded a trade surplus of $123.5 billion with the US, enabling China to bypass some tariffs via transshipment. According to Vietnam's Ministry of Industry and Trade, Apple supplier Foxconn has leveraged Vietnam's free trade agreement with the EU to increase its exports from Vietnam to the EU to approximately $200 billion. Now, Trump's administration has extended its tariff measures to countries in Southeast Asia, including Vietnam and Cambodia. Chinese businessman Zhang Shenqi told Radio Free Asia that the U.S. tariff on Vietnam, set at a flat rate of 46%, 12 percentage points higher than China's, sends a clear message. The strategy of relocating Chinese goods to Vietnam to circumvent tariffs has been directly targeted. Vietnam's role as a substitute export base has effectively collapsed, and the space for tariff avoidance through transshipment has been substantially reduced. The head of an electronics factory in Guangdong said that they originally planned to move the production line to Vietnam, but for now, with the tariffs, the cost is even higher than directly exporting to the US. After the disruption of transshipment trade, Chinese companies are forced to face high tariffs directly. For example, the share of China's photovoltaic industry in the US market could decline by 34% due to the tariff hike. Trump has also extended tariffs to goods transshipped from China to Mexico. A cross-border logistics worker revealed that in the past, they could save 30% in tariffs by transshipping through Mexico, but now this route is blocked by the US. It's clear that the US is really trying everything to deal with China. The tariff war and anti-dumping investigations could also trigger a domino effect. If Chinese goods shift to other markets, it can cause local prices to plummet or industries to suffer. So these countries may follow the US's lead and adopt protectionist measures. Countries like Brazil, India, Mexico, and Indonesia have joined the US and the EU in launching anti-dumping investigations against Chinese goods, meaning Chinese exporters could face a nowhere-to-go dead end. The US tariff hammer is still far from over, and the storm faced by cross-border e-commerce businesses is just beginning. Export jewelry business owner Shi Wen has been in the industry for over a decade, and he told Chinese media that other markets are much smaller than the US. He is also involved in the Southeast Asian and Australian markets, but they represent only a small portion of his business. There's still a big noticeable gap, especially during peak seasons. Markets in the UK, France, and other places are small and already highly competitive, so it falls far behind the US. The cost for returns and after-sales services in Europe are also quite high. In recent months, the European Union has been on edge due to the US preparing to raise tariffs. Chinese manufacturers may further dump goods at lower prices to increase their market share in the EU. EU officials are preparing emergency measures to prevent a flood of Chinese products from either directly entering or being transshipped through other Asian countries into Europe. The Financial Times also reported on April 4th that analysts warned that after President Trump's broad tariff hikes on various countries, a large amount of low-priced Chinese goods could shift to Europe. To counter this, the EU is considering measures to protect itself from a surge of cheap goods from Asia. The US has already imposed a 20% tariff on EU products, and European manufacturers are also suffering from US tariffs on automobiles and steel. Now facing a new round of US tariffs, the EU must deal not only with the impact on itself, but also with the pressure of Chinese goods, especially electrical appliances and machinery. An economist at Nomura Securities stated that due to the unexpected size of the new US tariffs on China, the risk of China dumping products into Europe will rise significantly. The Financial Times reported that the European Commission is preparing new emergency tariffs to address this situation and has increased its monitoring of import flows. A senior EU diplomat suggested that the EU might need to implement safeguard measures for additional industries, which could become another significant source of tension in EU-China relations. They also expressed doubt that China would alter its model of exporting excess production capacity. The diplomat added that the EU has already imposed tariffs of up to 35% on Chinese electric vehicles and may next impose higher tariffs on other products. Trump's policy of imposing high tariffs on Chinese goods appears to be aimed at bringing manufacturing jobs back to the US, but it is widely seen as a form of trade protectionism. The core objective of this tariff policy is to reduce the US trade deficit while protecting domestic industries from the impact of imported goods. Trump believes that China achieves low-price dumping through government subsidies and steals US technology, which has harmed US manufacturing and innovation capabilities. This viewpoint has gained public support for the tariff war and has become a key justification for the US to take trade protection measures. It has also gained significant traction in US political circles. Tom, a small business owner in Silicon Valley, posted about his experience. In 2018, his company collaborated with a Chinese partner to develop new battery technology. The following year, he visited Shenzhen and found an identical knockoff product selling for half the price. He said, "I spent $5 million on R&D, and the Chinese took it for free. I don't even know where to file a lawsuit." The U.S. Chamber of Commerce revealed that 70% of American companies in China are forced to transfer technology. The latest reports indicate that due to forced technology transfers and patent piracy, China causes U.S. companies to lose $300 billion annually. No wonder Tom was furious, expressing that the new technology he developed had been stolen by the Chinese, forcing American companies to buy their knockoffs, which were taken from the U.S. He described it as a huge scam. Tom's posts, along with similar cases, were some of the public support for Trump's decision to impose a 54% tariff. Counterfeit Chinese products are widespread, operating in the gray area between imitation and infringement. It has long been criticized by brand manufacturers and international brands. Given the backdrop of China's economic challenges, weak domestic demand, a real estate crisis, and high youth unemployment, the U.S.'s proposed 54% comprehensive tariff will inevitably deal a heavy blow to China. On April 5th, China political expert Yuan Bin published an article outlining the multidimensional and deep impacts this new round of U.S. tariffs will have on China's economy and society, with 6 main effects. 1. Direct blow to the export economy. The 54% tariff will significantly erode the price of competitiveness of Chinese goods in the U.S. market. Exports to the U.S. could shrink by 30 to 40%, amounting to a loss approximately $300 billion annually. Based on 2023 data, China's exports to the U.S. made up about 17% of its total global exports. Key sectors likely to be hit hardest include electronics, 40% of exports to the U.S., textiles, 12%, and plastic products, 7%. Additionally, cross-border e-commerce is expected to undergo a major shakeup with the removal of the small parcel tax exemption and the implementation of new tariffs. China's cross-border e-commerce, valued at 2.4 trillion yuan in 2023, faces potentially devastating impacts. Small and micro enterprises in hubs like Shenzhen and Yiwu could experience widespread bankruptcies. 2. Acceleration of industrial chain relocation. Under tariff pressure, companies such as Apple shifting supply chains to India and Tesla building factories in Mexico exemplify a broader trend. China's intermediate goods exports comprise 60% of exports to the U.S., face systemic replacement risks. For instance, Vietnam's exports to the U.S. increased by 18% in 2023 as it absorbed production capacity relocated from China in electronics assembly and textiles. 3. Surge in unemployment. China's unemployment rate has surpassed the warning threshold. Currently, around 180 million people are employed in export-related sectors. If production capacity contracts by 20%, it could result in 36 million additional unemployed individuals. The youth unemployment rate could exceed 25%, fueling a vicious cycle in which college graduates face graduation into unemployment. 4. Pressure on currency devaluation. A narrowing trade surplus will weaken support for the yuan. Accelerated depletion of foreign exchange reserves could trigger capital outflows and reinforce expectations of further devaluation. The renminbi could depreciate to a range of 7.8 to 8.2 against the US dollar, increasing imported inflation pressures. 5. Shrinking consumer market. Growth in disposable income for urban residents is expected to slow further. Coupled with rising precautionary savings, household deposits have now surpassed 135 trillion yuan. This trend threatens the effectiveness of policies aimed at stimulating domestic consumption. 6. Formation of a technology blockade. The combination of U.S. tariff policies and the entity list has already led to sanctions on more than 1,200 Chinese firms. This has blocked China's access to critical technologies in sectors like semiconductors and artificial intelligence. At companies such as SMIC, equipment depreciation rates have reached 47%, and the technology gap with global leaders may widen to 5 to 7 years. Yuan Bin argues that the 54% tariff will not merely impact surface-level economic indicators. It could initiate a downward spiral of shrinking exports, rising unemployment, weakening consumption, and reduced investment. This negative feedback loop could amplify existing structural challenges, including the real estate crisis, local government debt, and population aging. However, due to systemic path dependencies, the Chinese government's capacity to effectively respond is highly constrained. As a result, the authoritarian regime may face even deeper crises.